Good afternoon, good Thursday afternoon to everyone who's joined us so far, and welcome to our regular weekly webinar, Innovative Business Advisors regular weekly webinar. I'm going to get started very quickly because we've got a great topic today, and I don't want to waste time with a kind of front-end explainer, but just a reminder to everyone, we're on a Zoom portal. If you're new to the webinar, we do record the full content of the webinar, both in video form, and we will send out after the webinar a copy of the PowerPoint presentation that you're seeing on the screen throughout the webinar. Additionally, we will open the session up for our questions and answers. We will try to answer all questions live during the webinar. However, if we have unanswered questions, you can type those questions into the Q&A box. You will see a avatar for Q&A at the bottom of your screen in the Zoom portal. Type your question in there and we will answer it during the webinar. If there are any that are not covered during the webinar, we will send a transcript of the questions and answers along with the PowerPoint presentation, or we will post it, if you will, on our Google Docs page. With that said, I'd like to let you know what we're doing today, and that is Steve will handle the core presentation as he normally does, with an update on happenings around the programs available to you as a business related to the COVID crisis that we're going to. Additionally, we have a great speaker today. We have Peter Racen, who is Director of Estate and Business Planning with Northwestern Mutual. He runs his own firm, which is the Racen Wealth Management Group, and he and Terry will have a discussion for us addressing issues that are key at this point in time. So with that said, Steve, take it away. I'm going to turn it over to you so that we can get started.
Excellent, Marquita. And as always, we thank you very much for your leadership in moderating these each Thursday afternoon. All right, so just a quick agenda. We'll do a couple of aid updates and then move right into Terry's discussion with Peter. So here we are, Thursday afternoon. This morning, jobless claims came out again this week, and unfortunately, they ticked back up a little bit, 1.42 million, which, you know, with what we know that's going on in the country, with the pandemic seeming to have raised its ugly head again, unemployment claims did take a slight tick up. Also, just thought I'd share, it was quite interesting. This passed my desk earlier this morning, courtesy of the Wall Street Journal. They had posted an article on small business employment. We all know that small business has been severely affected, but I think when you see it in graph format, it just almost knocked me over. You know, when you see the effect that the pandemic has had with employees working in locations opening, dropping into the 40 percentile category during the pandemic, and we're still under 80% of businesses that are open here. It's really quite shattering. But let's get back into the aid program. There are a couple of updates to share with you this week. First, on PPP loan forgiveness, the SBA portal for lenders to record the forgiveness applications is still not open. What we're hearing is that it's probably going to be somewhere in the second week of August at this point in time. And as everybody may be well aware, Congress is contemplating a new tranche of aid, and it is thought that that may have an impact on when the PPP loan application portal becomes open. Do want to highlight that as of last Friday, there is still over $130 billion worth of PPP funding that's available. So if you have not taken advantage of the PPP program, there is still lots of funding available. And one key thing to note, one of the key provisions that is being discussed in this current aid program that Congress is going back and forth on is a provision that would automatically forgive any loan of $150,000 or less. And the Bankers Association and key lenders have come out in favor of that provision. And that could well become a component of the next form of aid funding that's out there. So if you haven't taken advantage of PPP, there's still plenty of money available. Talk to your local lender and get your application in. Next big update is on EIDL. That program had closed temporarily. It is back available. So the economic injury disaster loans are available for small businesses. Just a couple of quick notes. There's been $164 billion worth of EIDL loans that have been approved so far, and almost 10 million small businesses have been funded in that regard. So pretty effective program. And again, if you're a small business that has been affected by this pandemic and you have not applied for an EIDL loan, that window is now open again. So you're available to do that. And then finally, the Main Street Lending Program for small and medium-sized businesses is open. Please call your lender and find out if your lender is participating in that. That's another lender direct program. Also wanted to just take a minute and talk about an SBA special debt relief program. For those businesses that have any form of SBA loan outstanding right now, and those loans were current and in a current status, the SBA is paying 6 months of principal, interest, and fees for the borrowers. This is not a deferral. The SBA is actually making 6 months of payments for you. And that's for all current borrowers that have either a 7A, a 504, or even the microloan program. So pretty nice benefit for current borrowers. If you're not a current borrower, but you are a business that might have some other debt, you might want to consider rolling into a new SBA loan product, because a new SBA loan that is funded before September 27th would also be eligible for that 6 months of free principal, interest, and fees. So if you're a business out there and you've got some existing loans, you might want to take a good look at seeing if you have the availability of rolling into a new SBA program and basically getting 6 months of principal and interest made for you. So a couple of key updates this week. I hope it's helpful. And with that, I'm going to turn it over to Terry.
All right. Thank you very much, Steve. Great update. Peter, welcome. It's great to have you on the webinar. What we've pivoted from as the COVID stuff has kind of settled down a little bit, we're still obviously going through it, but to focus on things that are relevant to our CEO to CEO program, Chief Everything Officer to Chief Executive Officer. And a lot of what we talk about in that program is financial planning and getting yourself, through the succession of your business and things like that. So Peter, it's great to have you on. Thank you very much.
Thanks for having me.
So one of the key questions that Steve and I deal with a lot is valuations. So, there's always this kind of persona that a business owner thinks their business is worth a certain value. And Peter, how do you see the importance of having a very good valuation, as a reality check to helping that business owner get to their goals of retirement?
Yeah, that's a good question, Terry. Over the years, I've asked a lot of business owners what they think the value of their company is, and I get a broad range of answers. Everything from, I know of another business down the street who is in the same industry as I am, and they sold their business for X amount. Or I heard things like, I've heard that my business is worth 10 times earnings before interest, taxes, depreciation, amortization, EBITDA. So it's all over the map. But until a formal valuation is actually done, you really don't know what your business is worth. And at the end of the day, if you're especially going to sell to an outside buyer, it's whatever an outside willing buyer's ready and willing to pay a willing seller. So usually it's a negotiated price in the scheme of things, but the importance of having a good understanding of your value while you're building the business is so important, so that because most business owners, the value of their company represents 80 to 90% of their net worth. And if they don't know that value, they can't really do proper, even personal financial planning, because they need to know that number. And they also need to know how can they protect, promote, and preserve the value of their company, so that when they're ready to walk out the door, and either turn it over to family members or a key employee or sell it to an outside buyer, then they really need to know how they can protect that value so there's enough money there that can meet their income needs the rest of their life.
Yeah. So I've been a CVA, a certified valuation analyst, for almost 5 years now, which I guess isn't a long time, but you've certainly seen a lot of business valuations in that period of time. And what you talked about earlier about the value of the company, revenue ruling 59-60. And I didn't really appreciate this statement until a couple of years into doing business valuations. But what it basically says is your company is worth what somebody is willing to pay for it and what you're willing to sell it for, all parties having reasonable facts. So it's important, because I think that the sad thing that Steve and I see a lot is when a business owner comes to you, a financial advisor, and says, my company's worth $10 million. And then somewhere down the road, we say the company's worth $5 million. And oh, by the way, that's before taxes. And that just, completely blows up a plan that you put together for them.
Exactly. I mean, for a lot of other reasons too, if the business is worth $10 million or $20 million, the other issue that a lot of business owners need to consider is, do they have a potential estate tax issue as well? And if they have this big illiquid asset, and God forbid if they passed away while they still own it, their estate may owe quite a bit of taxes. And if the bulk of their assets are tied up in the value of the company, their Uncle Sam wants their money in 9 months. So you have to figure out how can you structure it in a way that doesn't hurt the business, if the business has to come up with money to help the estate pay estate taxes. So yeah, that's a kind of a side issue. Another important reason for having the valuation done is, especially if you have partners in the business, from a buy-sell planning standpoint.
Yeah, so on the sell side, because that is very important. And we see that all the time where, gosh, I just had a phone call about it today. There's another person that wants to buy the company, but it hasn't, it's always kind of been talked about, right? Mm-hmm. And so if you can, talk a little bit about the importance of that buy-sell agreement, and more importantly, how it's funded, and what are ways to fund that buy-sell agreement. Right.
Well, again, buy-sell agreements is another topic that I've addressed with business owner clients over the years. And when I'll ask a business owner, first of all, do you have a buy-sell agreement? Sometimes they think they do, and in reality, they don't. Many times the provisions of the buy-sell agreement may be in what's called an operating agreement or a shareholder agreement. You really have to look at those agreements to see, does it have what I call buy-sell provisions in it that address the key. There's really 4 or 5 key issues in a buy-sell agreement. First of all, the valuation, like we were just talking about. How do you value the company? Secondly, what happens in the case of death, disability, or the person wants to retire, or just simply wants out of the business? So those are the key issues that have to be addressed in the buy-sell agreement. And the other thing to think through is, what do you as the shareholder want to have happen with your stock? I've had some cases where that particular shareholder wants to keep those shares in the family. They don't want to sell their shares if they died or became disabled or sold out at some point in time. They want to keep those shares in the family. So you have to look at each individual shareholder's goals and objectives and find out a couple things. You want to find out, first of all, their time horizon. When do they want to get out of the business? Because that's very important to know from a buy-sell planning standpoint. And that goes to really the funding aspect of it as well that you just mentioned. There's a number of different ways to fund a buy-sell agreement. Of course, with, everybody knows about using life insurance for providing a death benefit if somebody dies before selling their interest in the company. But there's also, many times I find the case of disability is not covered. So there's a special type of disability policy you can purchase called disability buyout insurance. So that works very similar to life insurance, except in the case of a disability, it pays out a benefit if the owner becomes totally disabled. But assume they live, to retirement and they're ready to walk out the door. There's not a death or a disability. The other issue is, especially if you want to keep the business closely held, like in a family or transfer to a key employee, those key employees or those family members typically don't have the assets or collateral to be able to effectively buy out the exiting owner. And that exiting owner still needs a stream of revenue or income coming in from some fashion. So usually what I recommend is to start early, first of all. That's a key thing to think about, is not waiting for that perfect day when you're, say, a couple years away from retirement, but start 10, 15, 20 years. In other words, start as soon as you possibly can. And it's somewhat counterintuitive to a lot of business owners. They say, well, why would I want to fund my own exit? Well, the reason you want to fund your own exit is so when you get to that point in time and you're ready to walk out the door, you don't have to worry about taking back a big promissory note and worried about what's going to happen to the future of the company and whether or not they're going to be able to pay that promissory note. So there's tools, there's things that we can help clients with, things like concepts called sinking funds. Sinking funds are just simply investment accounts that you set up to set money aside so that when you're ready to walk out the door, there's money already there. You can also set up key person type programs where it actually does double duty. It not only keeps those key people in place, because that's another key aspect of growing the value of the company, is attracting and retaining key people who can help you create and grow value in the company. So
typically those would be called golden handcuffs. And I mean, right. I had a situation a couple of years ago. We sold a company. It was a environmental drilling company, and it was a perfect scenario where the owners were husband and wife. They done a great job. They had two people that could run the company. So as far as what we call the hub and spoke, you know, they had two people that could run the company. They could go on vacations for 2 weeks at a time, and everything was fine. But it came to literally like the last 2 weeks before the company was sold, and we had to approach those two people and tell them that the company was going to be sold. Mm-hmm. And they did not do anything to put golden handcuffs on them. So it became a real squishy thing because the buyer would not buy if those two people didn't stay. So It was not without its bumps and bruises, but it still did work. So what are some tools that you can use as, quote, the golden handcuffs to keep somebody there like that?
Yeah, they're referred to as non-qualified plans. And that term non-qualified just simply means that they're not subject to ERISA rules and regulations like a qualified retirement plan would be. So a non-qualified plan you can carve out just for key people. You don't have to offer it to everybody in the company. So in other words, if you had a couple of key people that you wanted to, do this golden handcuff with and keep them in place, but not give them stock in the company, that's a whole nother topic that I talk about. Is instead of giving these key people stock in the company right away, because that opens up a whole nother can of worms, you could put together a non-qualified plan that basically sets money aside for those key people that they cannot touch for so many years. And again, the term non-qualified means that you can carve it out for these key people. It's not subject to the same rules and regulations of ERISA. And then if they decide to leave, if they decide the grass is greener, they don't get to take that money with them. That money stays with the company. So that's where the golden handcuff part of it comes into play. They'd have to think twice before leaving the company. But also what it does, it provides them with a sense of ownership, because at the end of the day, if they're helping the business owner create and grow value in the company, and the business owner sets up these non-qualified plans for them, and there's a whole different variety of these non-qualified plans. To give you a couple of examples, they're referred to as phantom stock plans or stock appreciation right plans. There's also what's called supplemental executive retirement plans. Those are all different forms of non-qualified plans. So it's a way for the business owner to recognize the contribution that those key people are making to help them create and grow value in the company, and also keep them in place so that when they're ready, when those people are ready to retire, there's this additional pot of money waiting for them when they get to that point in time.
Isn't it kind of crazy that, I mean, it is kind of true, and it's probably maybe shocking to some business owners that are listening, but in a way, a lot of times you are funding your own retirement, especially if you're going to sell it to a key employee. So we sadly see it often, you know, the importance of this is we see it often where the owner tells you that they have that key employee and the key employee wants to buy the company, but they've never set them up to buy the company.
Exactly.
So do you have any success stories that you can share with us of, you know, things where this has worked out positively? And I mean, I guess unfortunately, I mean, I got tons of stories I can share, but kind of curious just to hear your side of the fence also.
Well, I've got the unfortunate stories where, you know, let's say a business owner passed away unexpectedly and the spouse came in and tried to run the company because there wasn't an exit strategy in place. And I've seen it many, many times where, you know, in cases like that, where especially if the spouse has never worked in the company before, we typically see the value of the company really drop pretty quickly. I also talk about the fact that we're really trying to also protect the other stakeholders. You know, the other stakeholders are the employees, the customers, the vendors, sometimes the bank. And I encourage business owners to realize that there's more stakeholders besides themselves and their family. There's these other stakeholders. So, you know, in fact, we just had a recent example that it's a sad example, actually, where we have been working with a business owner for a number of years and had recommended that they take action in some of these areas. And he was a young guy. He was in his early 40s at the time. And just recently, we just learned that he passed away unexpectedly in his, I think it was his late 40s, early 50s. And he did not implement some of the things we recommended. So we really don't know what's going to happen to the business. His goal was actually to transfer to a key person. So hopefully the family will be able to work it out with this key person to be able to take over the business and maybe purchase the company from the family. But without the right amount of planning, that family may never fully realize the value that that business owner worked so hard to create over their lifetime.
Yeah.
On the positive side of stories, the way the stories go, one of my earliest clients that I worked with about 21 years ago when I got in the wealth management business, he has a very successful business. And at that time, when we first started working with him, his kids were just going into college. And he wasn't sure if they were going to have an interest in coming to the business. And he has all daughters. And fast forward, about 10 years after that, one of his son-in-laws became very interested in the company, and the son-in-law came into the company. And over the years, we've been able to put together a succession plan through a combination of different types of estate trusts that we work with an attorney to help put in place to transfer the business into these trusts. But the bottom line is the son-in-law is now operating the business on a daily basis. He's doing very well. The company's been growing. And so that's another example. If you do the right amount of planning up front, it just opens up the whole world of opportunities and flexibility and options that you wouldn't have if you haven't done the planning.
You know, and so any business owner that's listening, I mean, I could just echo those words and the importance of meeting with somebody like Peter. I was unfortunately involved with a family that the dad was in his 70s and tragically got killed. A tree limb fell on his head and he died. Mm-hmm. And there was no family planning done. And he had like 6 siblings. Mm-hmm. One was involved in the business, actually a couple of them, but there was a real unrealistic assumption of the value of the company. And it literally led that family down 10 years of chaos, mm-hmm. trying to get things straightened out, you know, and it's so sad because, you know, there's done right. There's plenty of ways to mitigate the tax situation and really provide for the succession of the company.
Exactly.
Hey, Terry and Peter, can I interject a question here? I want to remind all of the people in our audience, our participants, to go ahead and type your questions in the Q&A box. But in the meantime, Peter, I'd like to pose a general question to you. And the question really relates to planning horizon. I've seen some horror stories too, and often the stories that we retell our stories retold because the planning horizon was not there. And I am thinking of one very specifically that had to do with a scenario where when the plan started, which was on about a 2-year threshold, certain vehicles that were recommended for that business could not be invoked. There needed to be a longer time frame, like a 5-year investment before the the cash outflow could be invoked. Peter, could you speak to that and really address from your expert perspective, for the average business owner, when do you start that planning process, and when is the law, so to speak, the regulations going to catch you if you wait too long? 5 years, 4 years, 3 years? What's a good planning horizon?
Well, if the goal is to sell the business to an insider, like a family member or a key employee, I typically recommend a minimum of 5 years, but preferably 10 or more years. And the reason for that is, if you think about how money grows and compounds, and like I mentioned earlier, the key employee or family member typically don't have the capital or collateral themselves. So you actually have to help them accumulate that capital and collateral. And you can use these non-qualified plans I was just talking about as a way to help them accumulate that collateral and capital that they would need to help buy out the business owner. And I'm not aware of any, what you're referring to, Marquita, regarding regulations from that standpoint. I'd have to learn a little bit more about that situation. But just from a timing perspective, I think most people understand the power of compounding. Well, compounding has much more to do with time than it does amount. So the more time you have to let money grow and compound, you're going to have a bigger pot of money over a 10, 15-year period of time than you would over a 5-year period of time. You just don't have enough time to compound. And the other issue we run into is business owners always have to have this competing need for reinvesting money back in their business. They have capital equipment they need to spend money on many times. They have inventory they need to spend money on. They need to add more people. So what we help them do is identify what we call free available cash flow in the business that's above and beyond their normal capital expenditure needs and growth needs, and help them carve out that free available cash flow on an annual basis to help them set aside this money for their own exit strategy.
Yeah, and that's very important. So, it's interesting, just from my own experience of owning my business and building it to working at a bank and seeing financial advisors there. Talk about a little bit of the difference between a registered investment agent and, I guess where I'm going is just from my personal experience. I think before I sold my company, I probably didn't have $80,000 in investable assets. Then what happens to that business owner when he gets handed a 7-figure plus check? Mm-hmm. And the difference in advisors and the level of service that needs to go along with that.
Right. Well, obviously in the financial services industry, there's a whole slew of different types of financial advisors and the services they provide. I encourage people to look for someone who, first of all, is a fiduciary, someone who will take a fiduciary role and responsibility to help you manage your investments, but more importantly, also help you plan. So for example, I'm a certified financial planner professional, which is a recognized, many times it's probably one of the most publicly recognized designations. And as a certified financial planning professional, I am held to a fiduciary responsibility by the Certified Financial Planning Board. And then I also have ongoing continuing education requirements that I have to meet every year with the CFP board. I'm also an accredited investment planner, which means I'm certified to help, now I'm not an attorney, so I don't draft documents, but from a financial planning perspective, I help clients with that. And then on the wealth management side, as an investment advisor, I'm also a fiduciary and managing an investment account. So look for someone who has those type of credentials to help you, first of all, put a plan together. Because there are some advisors out there, all they do is investments, that they're not necessarily financial planners. And in my opinion, your point, Terry, if you all of a sudden have this big liquidity event, you've gone from managing your business, you know that very well, but now you have this pot of money from the sale of the company. You may not be that familiar with how to manage that money. And I was in that boat. Part of my story is I owned a family business for over 20 years and I sold it to a publicly traded company back in 1999. So this was before I decided to join Northwestern Mutual and get in the role I'm in today. And I had no idea how to manage that money. So I had to hire an advisor. And so depending on the type of advisor you hire, may not have the expertise to help you with the planning aspect and things you need to be considering beyond just the investment management.
Yeah, so I mean, that brings up another very valid point is I kind of wrote down obstacles, and I've always promoted, I have two mantras. One, it's not about sales and net income, it's about gross profit and cash flow. And two, it's not about what you sell your company for, it's what you get to keep net of taxes. Mm-hmm. So talk about, if you can, a little bit about how to mitigate the tax effect of a company. Because one of the things I talk about in my book is, I don't care what the sale price is of the company. I mean, in fact, it's the first page of my book, we talk about the allocation of assets, because the tax implications of the sale of a business can be huge. So, absolutely. I mean, there's an easy argument to say I can sell your company for a lower amount and you'll still net more money of taxes, just depending on how the allocation assets are. But I know that's a much deeper subject. So how can you help with that?
Well, that's a key issue that what we do is we form an advisory team with the client for the client's behalf. And the advisory team typically consists of myself, an accounting firm that specializes in structuring these deals, also usually an attorney to structure it properly. So we're looking at it from all different angles. The other thing that I encourage business owners, from a tax standpoint, they can consider charitable planning as part of their exit strategy. So if they have any charitable inclination at all, there's some things they can do prior to entering into an agreement to sell their company that could benefit not only themselves, but also benefit the charities they care about the most and provide for their family with a lifetime income. So there's some planning strategies around that. There's also, depending how you structure the sale, as you probably know, Terry, that it's either an asset-based sale many times, depending on the size of the company, or it's a stock sale. So depending on how you structure that, and also the allocation of your basis that you have in that stock is very critical. And making sure your accounting firm leading up to the sale has a good understanding of what your basis is in your stock, that can help you minimize taxes. And if you're selling it to an insider, like a family member, a key employee, there's another strategy we can help put in place that combines a stock sale along with a supplemental executive retirement plan. That's a deductible expense to the corporation. So we could make this a whole topic just on this alone, but that's a real cursory overview of some of the things that we can help clients look at.
I know, it's like throwing gas on the fire, right? Because it just makes my mind go crazy. So you talked a little bit about building a team. So isn't it so important? It's literally a team of people that you need to go through this process. It's not just you as the financial advisor. My gosh, I talk about a situation in my book where I bought a property management company, and the seller used an attorney that was an estate planning attorney. Mm-hmm. And she didn't really have transactional business experience. I mean, what's your experience with that? I mean, that can really be a problem, whether it's an attorney that's not used to it. So, I mean, if you can, talk a little bit about using somebody that has experience in M&A transactions and using the right CPA or the right attorney to get you through the process and building that team.
Yeah, that's so important. And the clients I've helped walk through that process, many times what I'll find is their current accountant or current attorney may not be the right person to help walk them through the process, because you really need someone who specializes in mergers and acquisition work. They can save you, they might cost a little more, but they can save you much more than what you pay them to help walk you through the process in the form of taxes or structuring it properly and doing proper due diligence. When a company is being purchased, I think a lot of times, sometimes the seller it's the first time they've ever gone through this process, so they have no idea what they're walking into. And sometimes even for the buyer, maybe the buyer's never done this before too. So having the right representatives on both sides of the table to help walk through the process is critical, and can really save a lot of problems and pain down the road.
You don't know what you don't know, right?
Exactly.
Somebody wrote a book to that name.
I think it's been around.
Website for it. You don't know what you don't know.com.
Right.
Steve Denny's got the second book coming out this fall. Cheap plug. But no, it is very important because, we see a lot of situations where, say an attorney will try and take control of the deal. And you're right, the owner and the seller, they may not know the right questions to ask. They don't understand, is this a valid question? Is this something out of left field? Or, another crazy thing is just confidentiality. I did a valuation on a dental practice, and the guy was the dentist, the doctor was really uptight about the confidentiality of the situation. And one of the, a big thing in a valuation of a dental practice is the number of patients that are insurance patients versus cash paying patients. So the wife was involved in a company. She calls the insurance company and says, I need to split of what our business is. And the insurance agent calls back to the office manager and says, hey, that valuation that you guys are doing for the sale of your business, it's this and this. And oh my God, it's just crazy. So, but that is important. So, taxes is a big thing. And how do you guys help mitigate the tax situation of clients, and what can be done ahead of time to, really avoid and get the maximum bottom line for the company?
Well, first of all, understanding what their basis is in the stock or in the company of their shares. Once we understand that, then we can do some planning around how to mitigate that. If the objective is selling to an outside buyer, a third party, you have to look at what is a third party willing, how are they willing to structure that? Many times the business owner wants a stock sale, but the buyer wants an asset-based sale. And now there are ways to meet both objectives, but depending on how it's structured, and also depends on your corporate structure, whether or not you're a C Corp or an LLC or an S Corp, also determines how that transaction is going to be taxed. So you need to understand your corporate structure, you need to understand your basis, and you need to understand how the deal is going to be structured, either as an asset purchase or a stock purchase. And you also want to avoid double taxation. So especially in the case of the C corporation, there's the possibility of, as an asset-based purchase, you might have double taxation at the corporate level and at the individual level when it's rolled out. So we first want to understand all those things first, and then work with the accountant and the attorney to see how the entire deal can be structured to minimize taxes. And as I mentioned earlier, we can look at charitable planning as an option as well to help reduce taxes, because if you transfer, say, some shares to a charitable remainder trust or donor advised fund or something like that, you can, depending on your corporate structure again, it's not effective for S Corps, but C Corps is a really good tool. You could essentially reduce your income taxes that year in the year you transfer that stock, and then you can also get income stream from that, and then benefit charity. So I always encourage clients, as I mentioned earlier, to consider charitable planning as part of their exit strategy if they're charitably inclined.
So here's kind of a broad question. What, if you could throw out, would be a general rule of thumb to look at for a return on your investment? Because obviously, hopefully the goal of selling your business is that you don't eat into the initial funds that you get from selling your business, and you retire on the income from those funds and hopefully grow it. So what would you look at from a realistic percentage from that perspective?
Well,
And the difference between a safe investment, more risky investment, etc.
Well, first of all, I think it really goes back to the financial planning part and looking at what are the cash flow needs for that person or that family when they sell their company. So doing the upfront personal planning is critical to understanding, is there going to be a gap by the time you sell the company and pay taxes, are you going to have enough to meet your lifestyle goals and objectives? So we kind of start there. And then we back into, based on those goals and objectives, we back into how do we structure the portfolio to generate the income and do it in a way that mitigates or minimizes risk in the portfolio to generate that income. So you may have heard there's a general rule called the safe withdrawal rate. And historically, that safe withdrawal rate has been about 4%. I think it's dropped. In my opinion, it's probably from a safety standpoint, you want to assume safe withdrawal rate. So what that means is, if you have $1 million of capital that you're generating your retirement income from, that $1 million, you should only typically, to make sure it lasts over your lifetime, you should typically only take 3.5% to 4% out of that portfolio per year. So at a minimum, to answer your question, Terry, at a minimum, you need to be earning 3.5% to 4% a year, and hopefully more than that, because you want to keep on growing the principal. So typically when we do financial planning with clients, we don't want to use outlandish rates of return. So we're typically using 5% to 7% kind of range of rates of return. We feel that that's more conservative assumptions. And then we also back tested with different probability analysis to make sure it's going to hold up through a variety of different market cycles, different taxes, different inflation rates of return. So I would say if you really want to be cautious, you want to assume in the 3.5% to 4% range from a withdrawal rate.
So 25% doesn't work?
No.
Come on, Peter, you're killing me. It's not like it was in the 80s, huh?
No.
So it's interesting though how it all kind of ties together. The valuation is a very important part, and at Innovative, I mean, we are all about building your team, and that's what's really so important about the valuation piece. I think is a great place to start, because you need to have a realistic valuation of what the company is, and then from there, we typically want to send a business owner to somebody like you to say, okay, what's my number? What do I need to retire? And everybody's situation is different, right? So if the company isn't at a value of what makes for them to sell it to retire, then it makes sense to go into, the coaching program. And that's why we have the CEO to CEO program that really helps them build value in the company. But there's just a lot of tools that are involved, from the financial side, from the attorney to the CPA to making sure that company is set up and ready to go. So I think, that's why I think it's great having you on the webinar today, because that is really a very valuable and a critically important piece to the puzzle. And you got to build a team, right?
Absolutely. Yep. Start early, build a team, and plan, and review the plan regularly.
Well, and that's one of the things that we talked about before the webinar. It's like, how important it is to relook at those buy-sell agreements, because things change over time, right? I mean, taxes change, laws change, and something that you wrote 10, 15 years ago may be, obsolete, so to speak.
Absolutely.
That far down the road. So, I think you would agree with me. Is that how you guys kind of work too, to build a team of people around that business owner to make sure they're getting to meet their goals?
Yeah, actually a few years ago, we came up with this process we call the Clients Advisor Summit. So when we do an annual review with some of our top business owner clients, we form an advisory team, and now the team varies. It's not, we don't have a static team. So depending on the client and what relationships they have already, we coordinate usually the scheduling of the meeting and also the content of the meeting, but we'll have the attorney, the accountant, and again, depending on the needs of the client, we might have a banker or maybe someone like yourself would be at that meeting. And the purpose of the meeting is to, first of all, hear from the client, what are their goals and objectives for the next year and things they're thinking about that they want to make sure they accomplish. And then the advisors come to the table with things they think the client should consider, especially, you know, we're always having new tax rules and legal things that come out all the time that clients need to address in their business or personal lives, and that can affect their planning. So for example, I might ask the attorney or the accountant to say, okay, what do you think from your perspective this client needs to consider implementing? So whether it be new trusts or changing how they structure their corporation from a tax standpoint. So there's all these things that they need to be considering, and having everybody at the table at the same time does a couple things. It saves a ton of time. It saves money in the end. Most importantly though, it gets everybody hearing the same goals and objectives at the same time. And the way I put it is we're all pulling on the same end of the rope at the same time. We're not working against each other. We're really trying to work as a team for the benefit of that client.
So very important. I mean, it really is. And, you know, Steve, you haven't chimed in, but I'm sure you got stories of, you know, I know you do, of situations you've seen also, and Marquita, you too. Just building that team of advisors is just so important. And, you know, especially when the company's not to where the owner has a realistic valuation, you know, where they think it should be, to get them there, the coaching process is really neat. So, Steve, you got anything to add to that, or?
No, I think Peter, you've hit the nail right on the head. And so many business owners are reluctant to do that because they keep thinking about, you know, what it's costing me in billable hours for these things. But the savings are just tremendous when you get the team working together. And that's what I think they miss. I think they're fearful of the bill that they're going to receive, but they don't realize that the savings can be in tens, hundreds, even millions of dollars. And it really is very, very important. We try and do that on our larger deals with our clients as we get ready to bring them to market, because if you're not doing the appropriate tax planning and business planning as you come to market, you might find yourself in a situation where you're responding to, you know, a buyer that now holds all the cards, right? The buyer's the one that's got the cash, so they get to dictate the terms. But if you don't have the appropriate planning up front and set the stage for doing the transaction in the way most advantage to the seller, you can often leave a tremendous amount of money on the table. And as Terry always says, it's not about what you sell for, it's what you get to keep at the end of the day. That's what really matters, right?
Exactly.
I got a question for you. This is, I personally believe we're in a very unique economic environment, and with all of the trillions of dollars of additional debt that's going to take place, I think it's going to change the economic environment in the future. I think we may be in, you know, like a World War rebuilding event for the next generation. I know you guys are thinking about this. Is there any particular thought process that you'd like to share with us and our audience about the way you guys see the future over the next, you know, 1, 5, 10 years, and what business owners should be doing now? Because, you know, for example, we may be in a low interest rate environment that, you know, we've never experienced in the last 50 years. How do you cope with that? Well,
on the investment side, absolutely. This low interest rate environment has been with us now since 2009. And everybody thought interest rates were going to start rising in 2014. They didn't, and now we're even lower than ever before. And it sounds like, based on the Federal Reserve, what they're talking, we're going to stay in a low interest rate environment at least for the next 3 years. And then the other concern along those lines, Steve, is what's going to happen with inflation. And hopefully we don't have hyperinflation like we did back in the 80s. You might recall when I remember my wife and I were buying our first house and mortgage rates were 18% in 1980. So hopefully we won't get back to that stage. But I think I'm really pro-American when it comes to just if you think about our country and how innovative we are as a country. I'm really encouraged by talking to some business owners and the opportunities that they're looking at. Despite the pandemic, they're actually still growing. Now, obviously, there are certain industries that are not doing as well, but there's, I think, good opportunity for companies who still continue to invest in their companies, who are looking at ways to be disruptors, in their industry, look for technologies that they can bring to the market that could benefit people. I think another big opportunity through all of this is more manufacturing coming back to the States. I'm glad to see that being talked about. I think if that happens in big numbers, that could just open up a whole lot of opportunities for many business owners and to expand their companies, offer more products and services, and build it here in America. So I'm kind of encouraged by those types of things. And historically, what we've looked at is through any pandemic over the past 10, 20, 30 years, the markets have always come out of it in a positive fashion within a relatively short period of time. I think in all but one case in the past 15 years, the markets were back positive within 3 months, all of but one case, I believe, and all were positive within 6 months and 12 months. So I think people should stay the course. I don't think they should panic. They should work with their advisor to have a good plan in place and really manage that plan. And then depending on their goals and objectives, have their portfolios positioned in a way that can help them manage risk in their portfolios. Maybe make them a little bit more defensive right now, be very cognizant of the fact that there's volatility, but position them to take advantage of low valuations right now in different sectors and different asset classes, so that they are positioned to take advantage once we get back into that period of time where we're back on the upswing.
Very interesting times, that's for sure. So, hey, we're getting close to the top of the hour here, and it is golf league night, so we don't want to go over. So, emphasize that. But, Peter, it's great to have you on. I mean, like I said before, at Innovative, we're all about building a team of people around that business owner. It's not just one. I love our CEO to CEO program, Chief Everything Officer to Chief Executive Officer, in our online program, the Business Profit Improvement Plan. And Steve, I think, did Trent send you, do you have a slide with a promo, $150 off? We regularly market that for $650, but if you go to the website, www.profitimprovementplan.com, and enter the promo code 150 off, that means you get $150 off. I guess that's pretty simple, right? So, but take advantage of that. I mean, we've literally had clients come to us and tell us that they would have not survived the COVID-19 financial crisis without the information that we provided them in the CEO plan, and in part, you'll see it in the Business Profit Improvement online course also. So, again, thanks for being on, Peter. Marquita, I'll turn it back over to you unless you guys got any other questions, and we'll wrap it up.
Okay, great, Terry. At this point, what we do, and Peter, for your benefit, I ask each of you to make a last comment as we go forward. But Terry, I'm going to kind of point at you a little bit, especially relative to the last chart, because I am extremely familiar with the CEO to CEO program, and I want to go back to the conversation that you and Peter were having earlier about funding a business, using your business excess cash to fund not only your professionals, your advisor team, but also to generate that incremental cash that is needed to invest in the instrument that your team recommends. And I know often, as you said, many business owners are hesitant to move forward because they think that they are not having that excess cash. Could you, for just a quick minute, Terry, as you do your wrap-up comments, talk about CEO to CEO and how we help clients find that excess cash in their business? Very briefly.
So, okay, now I'm going to be late for golf because we got to do a half an hour conversation. But no, it is. I mean, it's so important. I mean, it's really neat. One of the people that's in the program right now, she came to us. She owned a marketing company and she wanted to sell her business. So she's a marketing person. So she created, you know, a wonderful display of her business, posted it out on Biz by Sell, and got several inquiries. And all of a sudden she had that, oh my God moment. I don't know where to go from here. And she came to us through a referral from a friend, happened to be a cousin, whatever. But one, she didn't know the value of her business. Two, it wasn't enough that made sense for her to sell the company. Three, she didn't have decent financial statements. So, you know, that was a disaster. And it's just, and she would tell you that in certain ways, she's kind of embarrassed because she didn't know what she didn't know, right? And it's really refreshing to bring her through the course right now. And she's learning what she needs to have a successful, you know, selling her business. And we've introduced her to a fiduciary like Peter to help her understand what she needs to get out of her company in order to hit retirement. And it's this, and Peter, is not just about the value of the company. It's also, you know, she has a military husband. So what's coming in from there? It's all the pieces, right? I mean, you got to put it all together. So it's just really, she didn't have financial statements that made sense to present to a potential buyer, because like it or not, your financial statements are the face of your company. And it's so important, you know, to have those things right. And that's the first part of the CEO program, is to get those financial statements, what we call readable and relevant. And then to the later part, what Steve says, we got to make them sing. What's that an acronym, Steve?
The sing. You got to make them simple. You got to make them instant. You got to make them graphic, and you caught me off guard. I can't think of what the end is.
No, I'm a simple person. I can only remember readable and relevant. Steve's supposed to think. But really to understand how to manage your company by the ratios and the percentages, and to really understand the true value and bankability of the company. You know, are you a bankable person? Because if Peter says, you know, you need $5 million to retire on, and your company's only at a value of $2 million, then how are we going to grow that company? And likely you're going to have to borrow money. So are you a bankable person? And, you know, that's really what's, I think, just fascinating about the program. And, you know, naturally we're the ones that created it, so we think it's unique, but there's really nobody out there teaching this stuff. That, you know, you have to have a company, you have to understand your financial statements, you got to be bankable, and there's non-financial things that can not only affect the value or sellability of your company, but it can just kill it if you don't have it right. So.
Okay, Steve, with that said, I'm going to give you a chance to give us your last thoughts, and Peter, I'll come to you last. You'll get the absolutely last word. Steve.
Just want to say thank you to Peter. So grateful for your time today, Peter, and bringing your insight and wisdom. It is so important, and I just want to underscore what you said earlier. It really does take a team. If you really want to get the maximum value out of the business and not leave money on the table, you need to do some planning up front to plan for the best possible outcome. Make sure that that's in good shape, and you got to have the right advisor sitting at the table with you to really help you get to that brass ring that everybody's hoping to achieve at the end of their run in their business. So again, Peter, thanks so much for giving us the time today and the benefit of your wisdom. It's really very meaningful, and I know it'll be very helpful for our audience. So appreciate it.
Thank you.
Okay, and Peter, any last comment you want to make before I wrap it up?
Well, I appreciate everybody's time. I appreciate the opportunity to be on with you all. It's been a great hour spent with you. I would just say, for the business owners who are on the webinar this afternoon, I would encourage you to think about working with an advisor who specializes in working with business owners, help you put a team together, help you do the financial planning, and start early. I know you have a lot on your plate. You're trying to juggle a lot of different balls to meet your clients' needs and your employees' needs. But take a little bit of time to do this planning. I think it'll pay off. Put an advisory team together, and then look at ways to, what I call, protect, promote, and preserve the value of your company that you've worked so hard to create and grow. And we'd love the opportunity to work with you.
Okay, thank you so much, Peter. And again, thanks for joining us. Thanks, Terry and Steve, for your presentations and participation today. And to all of our participants, thank you for joining. Look for an email from us within the next 24 to 48 hours, recapping where you can get access to this information. We will post the full recording of the webinar on our YouTube channel, along with links to our Google Docs with the presentation and any other documents that we've shared throughout the process. So with that said, goodbye, everyone. Have a great Thursday night. And for those of you who are packing it in for the weekend, have a good weekend, and we'll see you next Thursday.